Once again, the authors of this textbook wanted to make sure we realized how cosmopolitan and global they are. So we're dealing with Bandar Industries of Malaysia. The irony is they found a Malaysian company that does business in US dollars and not Malaysian ringgits. So we'll make pretend we don't notice. So Bandar Industries manufactures sporting goods. One of the company's products is a football helmet. Requires a special plastic. During the quarter ending June 30, the company manufactured 3,500 helmets. It's probably important. It's a number. I'm an accountant. And accountants use a number. You hit it like a bass hits a silver minnow. Using 22,500 kilograms of plastic. And the plastic cost the company $171,000. According to the standard cost card, each helmet should require 0.6 of a kilogram at the cost of $8 per kilogram. Anyhow, so then it says, what is the standard quantity of kilograms of plastic that is allowed to make 3,500 helmets? Well, that's simply the number of helmets produced, 3,500 helmets, times 0.6 of a kilogram per helmet. So 3,500 helmets, 0.6 per, 2,100 kilos of plastic. Then they say, how much should that have cost? So we did that one. What is the standard materials cost? How much are we allowed to spend? Well, we just figured out the standard quantity. Now we have to figure out the standard price. And the standard price is $8 per kilo. So $8 times 21,000 kilograms, 168,000. And then they say, what is the standard cost allowed? Well, the standard cost allowed is this. Standard cost allowed for actual input. Okay. So that's 168,000. And the material spending variance, the difference between the actual cost given, which is 171,000, and what we were allowed to spend, 168,000, is $3,000, and that's unfavorable. The next thing they ask us to do is to break that down into the price variance component and the materials quantity component. Well, the way to do that is with these charts. Your book gets all hung up with the equation method and the casting eventuals and reading tea leaves and all kinds of other nonsense. This is the way that I know, and this is the way that I know how to do it, so it works all the time. Okay? It's already filled in for you, so I want you to just look at it and follow through my thinking. I want you to be able to go back and forth to what I had and what I have, and let's take a look. The actual quantity at the actual price of 171,000, they gave us that. So when you're doing these problems, when they give you something, just say thank you and move on. They gave us 171,000, we'll take it. Now, the next thing they tell us is that our actual quantity, let me get a different color here. Our actual quantity we used 22,500 kilograms of plastic. So that's our actual quantity. They gave us that. They gave us the standard price. Actual quantity times standard price. That's how much they expected us to spend if we paid the standard price for the actual quantity. So in this case, when we're looking at the price variance, we spent 171. We could have spent 190. That's a favorable price variance. Now we need to look at the other piece. Now we're comparing these two. For the price variance, we compared these two. That's the price variance. Now we're going to see, did we use more than we should have? Well, the standard quantity that we figured out over here is 2,100. That's how much we should have used. Had we used the standard quantity at the standard price, and the standard price they give us, $8 per kilogram, we would have spent 168,000. We did spend actual quantity at standard price, 168,000. If we could have gotten the actual quantity at our standard price, we would have paid 180,000. The standard quantity at the standard price, if we used what we expected and paid what we expected, it would have been 168,000. That's a $12,000 unfavorable quantity variance. So we used too much, paid too little. Very common. When you put them together, we come up with the total spending variance. And this often happens where you'll have a highly favorable price variance and a highly unfavorable quantity variance, or vice versa. That happens. It's not at all unusual, which is why you have to do them to come up with the answer. Now, when you're doing this, keep in mind, when you're combining the variances, if they're both U's or both F's, you simply add them and take whichever letter it is, favorable or unfavorable. If one is a U and one is an F, as we have here, subtract the small one from the large one and take the letter of the large one, which is what we did here. 9 from 12 is 3, and the large number is unfavorable. Let me just zoom down a little bit so you can see all my arrows. Just take a minute, think about it. We're comparing what we should have used and what we should have paid. Okay? Should have used, should have paid, really used, really paid, really used at what we should have paid. They're the three things that we're comparing. And once you get that down and it makes sense to you, you'll do it again and again and again for all the variances. The only difference between material variance and labor variance and overhead variance is the titles we use. the functions, the formula are exactly the same.